Here we're looking at a 15-minute Euro US dollar chart on the throes of a very tradable double top high at 2900. This whole scenario was a shift as a result of course, a technical level, key technical level, as well as some economic data that had come out, negative for Eurozone and positive for US dollar. And we see sometimes we'll see these moves here indicate simply a stimulus or an economic report that had provided motivation for or stimulus for a adjustment in price for the euro US dollar. Now this downtrend which moves, it is a US dollar decline of almost 200 pips, sorry, a US dollar rally of almost 200 pips and a euro decline of almost 200 pips. Now what happens here is this is partially it is a price adjustment in anticipation of a report that is coming out on this day. And there's actually a string of reports that are coming out on this day, about 8 reports in total, but there's one that is what we title a market moving report. And this report is the ISM Manufacturing Index. It is the Institute for Supply Management, which is a survey of nearly 400 manufacturing firms on employment, production, new orders, supplier deliveries, and inventories. It is a composite diffusion index of national manufacturing conditions, where a reading above 50% indicates expansion, or a reading below 50% indicates contraction of the factory sector. It is export orders, import orders, backlog orders, and prices paid for raw and unfinished materials. They are also measured in this index, but they're not really heavily weighted in the index. Now, what happened on this particular day was the consensus expectation was 56, which is expansionary. The actual number that came out was 54.4, which was a disappointment for the market, and it was actually quite surprising. It was because it was 57.3 in April, compared with the expectation of 56 for now in new orders, which point to future activity. It really fell on this day to 53.7 from 57.6, and new orders were as high as 61.9 in February. So backlogging orders also fell to 53 from 57, and there was also an employment indicator that came out that showed some weakness or some softness in the market. So what happened was, as a result, we see a move now. We'll watch to see the move. Usually when you see the market price in an expectation like this, so it was pricing in a strong report for the US dollar, which is negative for the euro. If it exceeds expectation, it's often choppy and maybe fairly volatile, and the trend may continue. Or if it meets expectation, we often, again, will get some volatility, and price may remain the same or go either way. In this case, the economic report disappointed the market. Okay? We priced in a positive expectation, and we disappointed the market, and those usually can lend to some very opportunistic trading situations. As a result, we see a nice rally. This is again, it's a 15-minute chart, so we see price rallying here as a result of the disappointment in the index. We bounce here at first resistance, and then we bounce again at second resistance. Right. So here's our first resistance. Here's our second resistance. Just want to show you how this also moves with some of the technicals. So we have a price adjustment of 100 pips immediately. However, in almost 24 hours, we have the non-farm payrolls coming out, and the market is going to now settle down and wait and probably range in about a 20 pip range for the non-farm payrolls report to come out. And we are waiting for non-farm payrolls. So the non-farm payrolls report, let's just the non-farm payrolls report, once again, just I'm sure many of you know about it. It's the most popularized economic report, and we covered it in the theory section. But it's simply it's also defined as the employment situation. It's a set of labor market indicators. What it does, it measures the unemployment rate of the number of unemployed as a percentage of the labor force. The non-farm payroll employment counts the number of paid employees working part-time or full-time in the nation's business and government establishments. The average work week reflects the number of hours worked in the non-farm sector. And then there's also a section called the average hourly earnings, which reveal the basic hourly rate for major industries as indicated in non-farm payrolls. So there's three main sections. Now here we're simply consolidating. We have the response to the ISM data, and then we are consolidating now, waiting on the non-farm payrolls report. And the expectation, consensus expectation, is 180,000. 180,000 is the number we are expecting here, and we're seeing price consolidate as traders simply just do not want to commit to taking any positions outside of transactions that where there are parties that will make transaction, and they're not concerned with non-farm payrolls. They're more or less consumer transactions which are being taken place through the bank. Therefore, you still will have some dealing, but on the speculative front, the non-deliverable speculative front is where the majority of the flows will be generated from, and there's clearly very, very little to no commitment on the speculative front. As we wait on the non-farm payrolls report, we are simply consolidating here, and then the report comes out. Look how tight consolidation is, as there's no commitment for foreign exchange transactions. Then we move instantly to in excess of 100 pips. The actual change, or the actual report that came out, again, the consensus expectation was 180,000, but the actual was 75,000, which is deeply disappointing for the US dollar, thus generating euro dollar strength or US dollar selling. So there's immediate reaction to sell US dollars as a result of the negative report that has come out, and an immediate price adjustment of 100 pips and more as a result.